Let's be careful about that nice start to Q1 and early Q2 because it was a really bad 4Q. So I think the question is, how much have we recouped thus far? When you look at oil more broadly, it's gone probably, you've got back roughly around 75% of that. And we don't think you're going to get back up to those 80 levels again. So it means we got a modest level of upside here. The core of the investment returns are going to come from what we're talking about is backwardation carry. Because that's the big shift here in this market, is that it's been a fundamental deficit. The lower inventories have driven cash and physical prices higher. The back end of the forward curve has remained flat, and you've picked up the carry going forward. Bottom line, this market's in a 1 million barrel per day deficit right now. We think the upside in prices is 70 to 75, but that back end is going to be anchored around 60. Why is it going to be anchored around 60? Well, you have the expansion of the Permian pipelines in 3Q. You have OPEC potentially having to exit the cut right now. Why? Because inventories are likely to be at the 5-year average sometime in May. And then you have more supply coming in from non-OPEC ex-US. That's what's going to keep that back end under pressure. Lower inventories push the front end up at 70, 75. We think that's the investment opportunity. But it's not going to be like what we saw in third and fourth quarter of last year.
So how soon before 70 to 75, and what will be the near-term driver for that?
Well, we've now just, in the last trading session, bumped up into that, touched the $70 a barrel mark. What's driving that is a deficit. You have demand, it's running somewhere right around 1.4 million barrels per day. I like to say it's steady as she goes. The demand picture, when we go back in 4Q last year, it didn't deteriorate as much as sentiment. That was more of a sentiment downturn and then a sentiment pop back up again. The underlying demand picture has remained much more stable. Put that in the context with the production cuts from OPEC and then big supply disruptions out of Venezuela, Iran, as well as Canada with the recent production cuts, has created a relatively tight near-term market.
I wanted to ask you about the situation in Iran as well, because this is a real opportunity for President Donald Trump to shake the tree. What's going to happen when those Iran waiver sanctions, the sanctions waivers expire?
Well, we think Iran's going to decline by roughly another 300,000 barrels per day. But the headline of the reduction in sanctions could be much larger. Why? Because you have a lot of unused waivers in places like Taiwan, Greece, and Italy. You take those away, the headline number may look much larger. But if we look at all of the different areas in the world in which the current administration is dealing with, North Korea, Venezuela, and Iran, the one in which they can move the needle the most on right now is Venezuela. Why? They have an opposition party leader in the form of Guaido.
What about on the topic of Iran, though? Can Iran really get to zero, or is that a head fake?
Well, if there was a time fundamentally at which you could see Iran exports go to zero, it would be roughly around third quarter of this year. Why? Because you have the pipe expansions coming out of the U.S. OPEC is in a production cut, so they could exit the cut. Unlike last year, they were in the reverse position, and then you have more supplies coming on out of non-OPEC ex-US. So if you had to pick a time to do it, third quarter of this year would probably be fundamentally the best time to do it.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.